All right, here we go, y'all. Hopefully, all the satellite students are sat down in front of your book, ready to go. We are only doing chapters 12 tonight, so we're going to be on page 207. I wish I could do 12 and 13 in the same class, but 13 is just a little too long. So I may get you out of here a little early tonight, around 9 o'clock. On page 207, you know how we get started. We go over our little learning objective list. And on our learning objective list, you see that we're going to describe factors that contribute to housing affordability. That would involve mortgage terms, ability to pay. We'll describe terms and conditions and use of the promissory note, explain elements in the use of security instruments, mortgage, deed of trust, and the roles and rights and obligations of the parties. We'll talk about different types of financing, and we'll distinguish between the different styles of foreclosure. And then we'll talk about some consumer protection laws that are tied to home ownership. And then down below there, you'll see some terms that you'll find in this chapter, terms that if they bother you, you can spend some time looking them up, writing down the definitions. So we turn the page and we start the conversation. I have coincidentally worked in both the mortgage industry and the real estate industry my entire career. I got in the mortgage business in 1994 for the first time, working with a friend of mine, Michael Bennett, and I've just done both of them simultaneously. Sometimes I go one, sometimes I go the other. I'm afflicted with the ADHD that contributes to it, but it's enabled me to be a better teacher. It's given me a more well-rounded knowledge of the entire industry, especially the transaction itself, because 8 out of 10 deals have financing. You're going to have to get used to that fact. We don't get paid unless the deal closes. So whether you think you know a lot about finance now or not, after 6 months in the business, you'll know more about finance than you ever did, because just your need to get paid makes you more curious about it. And here's the thing. You can spend an entire weekend showing a couple homes in the 160 to $170,000 price range. And then on Monday, they go to the mortgage professional, and the mortgage professional tells them they can't afford to borrow more than 159. You were this close, but you might as well have been showing them $1 million homes, because you were showing them homes they couldn't afford to buy. And that was an entire weekend. I don't know you and your relationship, but you might have need some QT with the old lady. You may need some quality time with the youngins. You may have had some errands and some chores to do. Hell, you could have rested and watched college football, but you wasted an entire weekend. And time is very valuable. I think most of us would agree in here. I think all of you would like to make as much as you can in 30 hours a week instead of 50 hours a week. Um, and that's one thing I harp on in post license. I hope y'all come see me after this class, because I focus on efficiency, because that's what I want to do. I want to make as much as you do in half the hours that you work, because I love myself and I love hanging out with my damn self. I like not working, you know what I mean? But when I work, it's focused. If I'm only going to work 4 hours a day, by God, I'm going to work 4 hours a day. I cram as much into those 4 hours as I can, but I'm off track, damn it. But finance can be a time waster. You can either be spending very valuable time showing people who can't get financing at all, or like the example I just gave you, can't get the amount of financing relative to the price range you were showing them properties in. Hell, that's the same as spending a weekend with somebody who can't get financing. So I think you'll know a lot more about real estate finance, about finance in general, after tonight's class than you ever thought you would know. It's not that big of a deal. You've heard me say that the majority of what's in this book is fairly elementary. It's just disguised by nerd words. It's just camouflaged with nerd words and made to seem bigger and fancier than it really is. So let's dive into it. Housing affordability is important to the United States. We've talked about several times throughout the course how the United States wants us to buy real estate because it's good for the economy. So the government tries to do as much as they can to lessen the cash requirement. The two strongest factors preventing people from purchasing real estate is credit and cash. Cash is more of a prohibiting factor than credit is, in fact, in the modern day. There are people who got fine credit, they don't have the cash for the down payment and credit and closing costs. If you read this page, you'll see that we've tended to hover between 62 and 70% as far as the number of adults owning versus renting. And that statistic is monitored by the government because they're always constantly trying to increase the number of people that own real estate. Over here on page 209, mortgage terms, ownership expenses, and ability to pay. We're going to talk about what it takes to qualify for mortgage financing. But the one thing that people don't understand is the beauty of getting in mortgage financing is you get locked in a payment if you get a fixed interest. I remember being about 30 years old and meeting an older couple, and they had a fine home in Alex City, which is where my daddy's family's from. And I remember listening to them having a conversation with somebody, and their mortgage payment was like $126 a month. And I thought, for this big home, but they'd been living in it for 25 years. You know what I mean? They got locked in at an interest rate when they were young, just got married, and you get to pay that the whole way through. Whereas if you rent, they step up your rent 5% every time. You may be paying $800 a month rent for a one bedroom now, but in 10 years you'll be paying $1,400 a month for that very same one bedroom, and it ain't fancier or nicer. So there are risk factors that determine a person's likelihood of default, just like there are risk factors that determine the likelihood of me and you filing an insurance claim. Like when I go to get automobile insurance, it's not a given that I'm deserving of automobile insurance. They're going to check me out. But there are things about me that are indicators of my likelihood of having an accident. My age. Anytime you go get insurance, they're going to ask you your age because younger people tend to have more claims than older people. Because when you're young, you're full of P and V and you're hauling butt and you're having fun and texting and eating and having wrecks. So they want to know my age. They want to know my gender. Why? Because it's a fact males have more wrecks than females. We're in a damn hurry. We're trying to get somewhere. We got things to do. Y'all girls, y'all just lollygagging. Y'all the one causing all the damn accidents. You stuck now, man. We're going to have to sit here and look at you for 20 minutes. All right, here we go. All right. Uh, they're going to want to know, the insurance company, before they give me automobile insurance, going to want to know what size city I live in. Why? Because people live in big cities have more wrecks than people live in small cities. They're going to want to know how many miles I drive a day. Why? Because the more miles you drive, the stronger the likelihood you're going to have an accident. They're going to want to know what kind of car I got. Why? Because people that buy sporty cars tend to have more accidents than people who drive more conservative cars. So these are all risk factors, and they feed into actuaries. They feed into the rates that we're charged by insurance companies. Well, there are indicators about borrowers too. While I gave you examples of risk factors that indicate my likelihood of filing an insurance claim, there are risk factors about me as a borrower that indicate my likelihood of default. And they're not arbitrary. What they require of a borrower is not random. What they do periodically is they take bunches of mortgages that foreclosed, and you look in the file, you see what the borrower's situation was at the time they borrowed the money. And you feed all that into an algorithm. What does the algorithm do? Search for common threads. Do you see? And those common threads end up being what? Indicators of the likelihood of default. So that's what mortgage terms are all about addressing, and the ownership expenses and your ability to pay. You know, just last year in October, I was driving down the interstate with a buddy of mine, and we were heading somewhere to UAB basketball game, I think. And he was speeding, and he said, "Man, I better slow down. I can't get me 2 tickets." I said, "What you talking about, 2 tickets?" He said, "Well, I got a ticket because I lost my driver's license." But so, now he'd lent it to his brother-in-law. I'm afflicted, y'all, and I'm getting distracted. Let me get my mind right. So as we're driving down the road talking, he said, "I'm sorry, I'm in a bad mood tonight, Mark." I said, "Well, why are you in a bad mood?" He said, "Well, my brother-in-law, my sister's husband, he's unemployed and he's an alcoholic. And this story is not meant to make fun of either of those. And he said he came to me 8 months ago, Mark, wanting to borrow $5,000. I told him, let me spend a couple of days to think about it. I spent a couple of days thinking about it, and I ended up letting my brother-in-law have the money. We came up with an arrangement. He was going to make a monthly payment to me. And that was 8 months ago, and I ain't got one damn payment from him in 8 months. And I said, Philip, I love you like a brother, but I said, the only person you got a right to be mad at is your damn self. You realistically thought a person with a substance abuse issue who had no source of employment was going to honor his promise? Was that really what you thought? That's like putting $2 on a horse with 3 legs, and thinking you got a good shot, I mean, so, you know, if, I listened to Dave Ramsey one night on the radio, and he said something that hit me between the eyes. He said, if someone you love wants to borrow money from you, he said, if you can't afford to give it to them, don't loan it to them. And man, I thought, because, there are precious relationships that have been ruined over the animosity over a $50 loan. Yeah, over $100, over $500. Precious relationships that don't need to be affected by such trivial things. But let's say someone you loved came to you needing to borrow $5,000, and all you had in the world was $5,000. In fact, you can't afford to loan it to somebody and not get it back. You got to get it back. Would you not expect the person to have a job if that was the conditions? Yeah. And then I want to see their pay stub. Why? Because I want to see how much they make. Because I want to see if the amount they make includes the amount they agreed to pay me. And then I ain't stupid. I know you got other bills. I want to see your other bills. Because I want to subtract all your other monthly bills from your monthly pay to see how much you got left over. To see if it includes me in case you decide to deprioritize me. And then I want to see if you're living check to check, even if you pay me, because sometimes life throws you an uppercut. And you got to be square, feet on the ground. You got to absorb it. You can't put yourself in a position in life to where you can't take an uppercut that life throws you. I got friends living check to check. Oh, you see them from the outside, they live in suites. They got the clothes, they got the car, but they one unplanned expense away from everything tumbling. You can't be fair to yourself and do that. But my point is, at the end, the ultimate decision-making factor is I'm going to base my decision on whether I loan you that $5,000 based on your history of our handshakes throughout our relationship, which is the equivalent of a man's credit report. So what I just told you is logical, commonsensical, what you would expect of someone if you needed the money back. What I just told you is what a lender expects. They expect you to have a job. They want to see how much money you make. They want to see what your other bills are. And they want to see how much income you got left over after your other bills to see if you could absorb an uppercut life throws you every now and then. And then ultimately they're going to make the decision based on your history of your handshakes with others, which is your credit report. That is the simplicity that lies behind the criteria to acquire mortgage financing. It's just they go nerd it up. So we'll talk about how they nerding it up and all that. The bottom of page 209, that last two paragraphs. They talk about credit. Credit has become, society determined about 20 years ago to determine our worth to the world based on a three-digit number. Fair or unfair? And man, it surprises me to see people so casual about their credit because we only got one shot on this dirt. And your quality of life is affected by those three digits. And so many people, man, a damn fancy winter coat is more important than their credit score, or a pair of shoes, or a concert, or a vacation. It's like I can't get over the priorities people establish. They decided to take credit scoring out of the human being's hands around the year 2000. Prior to the year 2000, human beings evaluated credit. But you know what human beings do? We make mistakes. And sometimes we miss things. So finally, the industry thought, borrowers aren't deserved of that because humans make mistakes. So they said, we got to take the credit evaluation out of the human being's hands and put it in a software program's hands. Because the software program doesn't make mistakes. Or if it does make mistakes, guess what? It affects everybody, not just one person. Because it's in a chink in the software. And credit scoring has improved drastically since it first came out, and it is continuing to improve. But it's something we need to be very mindful of. And they've got a lot of quality sites in the modern day. I don't know what took them so long to get the websites up on, but they're there now. Credit Karma and the like. There used to be a bunch of bogus websites where you had to give them a credit card and all this kind of stuff. Now these are legit. Not only do they give you a simulated credit score, but they tell you the recipe of the credit score, what percentage of your credit score comes from this factor, what percentage of your credit score comes from this factor, and it tells you how to improve your credit within this range. So, man, it's good stuff. And if y'all haven't been to Credit Karma and signed up, got your little account or the like, because there's some competitors to Credit Karma now, you need to, because it's very educational. And you get credit card and loan solicitations that are relative to your credit situation, which is a beautiful thing. So, in the fact that all these sites exist now, Credit Karma and the like, it's making our job easier because now the consumer comes to us more likely prepared from a credit standpoint than they might have 10 or 15 years ago before these websites came about to teach us and learn us. So, if you read that last paragraph, the highest credit score you can get is 850. I just reached 800 within the last 3 or 4 months. I've been trying to obtain that number for years, and it's been elusive. I could never get it. And I'm not having this conversation to brag because I'm sure a lot of y'all have great credit scores. I'm just saying. But listen to this. I am an old school guy, and if I don't get a statement in the mail, I will not make a payment. You know what I mean? My mind just don't think to make it. So I got a little $45. I pay my balances off on my credit cards. A little $45 credit card from Capital One, and I didn't pay it. And I got a 30-day late, and I called Capital One. I said, I've been with y'all 15 years. I ain't never missed a payment. Can y'all get that removed? They said no. So don't go to Capital One. I'll piss on them. I think. Anyway, God, that was completely uncalled for. I can't believe I said that. I'm sorry. Nevertheless, I got 130-day. I've had 130-day late since 1989. And my score just went from 801 to 704. Yeah, 130-day late. I went from 801 to 704. So it is critical, So credit scoring, it's a booger. It's frustrating, but it's very important. And, you turn the page to page 210, and they continue the conversation talking about affordability. I've already made the point to you that they don't want us living check to check. So they do, in fact, want a certain percentage of our income to be free and clear of any debt. They give you some examples of that lighter type in the indented, that in practice, you see there that in conventional mortgages, uh, your monthly payment on your home cannot be more than 28% of your gross monthly income. And all of your debt, including your monthly mortgage, cannot exceed 36% of your gross monthly income. That leaves you 64% to pay taxes, because you keep hearing me say gross monthly income. So you've got 64% to pay taxes and other debts that aren't considered. Like debts that aren't considered in the 36% are groceries, utilities, cell phone, child care, insurance. The only debts that they count are installment loans, like anything you make a monthly payment on that has a period of time before it's paid out, like a car, or maybe you finance some furniture, maybe you finance some jewelry, maybe you got a student loan, whatever. Installment and credit cards, those and child support. Really, that's the majority of the debt they count. All of your other debt they don't even consider. But you very well could have a question on an exam where it says, what's the maximum this person's monthly payment could be? They're going to give you the information in the question you would need to get the answer right, but there's an example indented of the thought process behind that. You also see, look under that in practice, two paragraphs down, and you see in bold print, loan to value ratio. If I went into a mortgage lender and I said, what kind of loans you got? Well, they said, we got a 5% down loan, Mr. Yarbrough, a 10% down one. We got a 20%. How much you want to put down? I said, I want to put 5% down. So they would end up giving me what mortgage people call a 95% LTV, because the loan is $95,000 if I bought $100,000 house. So is the loan 95% of the value? It is. Hence the reason they call that a 95% loan to value. Loan to value. Okay, so anytime you see LTV and you see the number, that just means the balance of the loan. They may say Mark's current LTV in the home he's been in for the last 16 years is 67% LTV. What does that mean? The balance on my loan is 67% of what the property is worth on the streets. It's market value. So LTV is just the balance of the loan relative to the value of the property. Moving down the page, you see promissory note. Guys, I'm as guilty as the next layperson when I say, did you make your mortgage payment this month? We don't make mortgage payments. We make note payments. When we go to borrow money at the real estate closing, we sign a promissory note and a mortgage. The promissory note is the finance agreement between the mortgage lender and the borrower to pay X number of dollars back over a certain term, each at a certain rate. The promissory note is about the money only. The mortgage is about the note and the property. But the promissory note, figuratively speaking, post-closing, is stapled to the mortgage. It's a part of it. And in a promissory note, there's a promisor and a promisee. The promisor is the person who borrowed the money. They're making a promise to pay the money back. Sometimes they call the promisor the maker. They made the promise, the maker of the promise. At the bottom of the page, they say a note is a negotiable instrument. A lot of you know that debt is a commodity. It is bought and sold amongst businesses. If you don't know that, you're about to find out it is. I'll give you a very simple example, though. What if I'm selling a motorcycle for $2,000? My buddy's interested in it, but he says, Mark, I don't have $2,000. Let's say I'm selling the motorcycle for $2,400. That makes the math easier. He says, I ain't got 2,400, but I'll pay you $100 a month for 2 years. That comes to $2,400. I say, okay. So I'll write up a little promissory note. He signs it. He's making me $100 a month payment for 24 months. He makes the payment faithfully for 12 months. The balance on the loan is now $1,200. My buddy is selling his Sea-Doo for $1,200. I say, hey, buddy, I don't have $1,200, but I got a promissory note that Ricky's paying me $100 a month on with a $1,200 balance. Would you receive that promissory note in lieu of $1,200 cash? My buddy says, yeah, why not? So much like you could write me a check for $50 and I could endorse it and give it to somebody that I owe $50 to, you can treat a promissory note in the same way. Debt is a commodity. It is bought and sold. Over on page 211, you see interest. That is the rent on money. When you borrow money, they charge you rent. You can think of interest as the rent payment on the money you borrow. And every time you make a monthly payment, the rent is for the previous 30 days. You'll see in that paragraph, 5 lines down, italicized, that interest is paid in arrears. I want you to highlight that. You may need to know that on the exam. So let's say this is May. Let's say this is June. Let's say this is July. When I make my July monthly mortgage payment, most of you know, and if you don't, I'm about to tell you, that your monthly payment includes 4 components, PITI. Principal and interest, that's the loan, and then 1/12 of your property taxes, and then 1/12 of your mortgage, homeowner's insurance. That's your monthly mortgage payment. Well, the interest portion of your monthly payment covers the previous 31 days. Okay? Like when I made my June payment, it was PITI. And the interest portion of my monthly payment was the interest covering the previous 30 days. In arrears is the opposite of in advance. Like we pay rent in advance. I would pay June's rent on June 1. But when I'm making a June mortgage payment, the interest portion of it is covering the month of May. So just know that in general, interest is paid in arrears. Usury, I referenced this last week to make a point, but every state has usury laws, and a usury law is a maximum interest rate that a lender can charge a borrower. In other words, if you charge higher than the usury rate, you could be deemed breaking the law. Interestingly enough, mortgage financing is not covered under usury laws. It says that on the second paragraph under usury as of March 31, 1980. Federal law exempts federally related residential first mortgages made after that date. They can. Loan origination fee at the very bottom of page 211. Most closing, and all of us have heard of closing costs, and we know what closing costs are. They are the costs that we associated with acquiring a mortgage. Whenever you purchase real estate, like your home, there's going to be inspections, appraisals, there's going to be insurance, there's interest paid, there's a survey paid. There's a lot of people involved in a real estate transaction. And if you were to look at a set of closing costs that somebody paid on a particular transaction, a lot of it's self-explanatory. You might be looking at the accounting of a real estate transaction that closed on 123 Happy Street last week, and you may see where Mark paid, where it says survey, and then to the right, $400. And you think, well, a surveyor performed a survey, and apparently they charged $400. You might come skimming down, you might see appraisal, and then to the right you see 450, and you might deduce that the property was appraised, an appraiser performed the appraisal and is charging the borrower $450. They're self-explanatory: appraisal, survey, closing attorney, etc. The one that's not self-explanatory is origination fee at the bottom of the page. The origination fee is the closing cost that the mortgage lender charges. See, mortgage lenders don't earn the interest that the mortgages generate. They sell the mortgages after the closing. So they've got to make some money somewhere. So if they're not going to earn the interest, they charge origination fees at the closing. So when you're looking at closing costs, you might see home inspection fee, appraisal fee, survey fee, and then you see origination fee. The origination fee is not self-explanatory like the home inspection fee. It's the fee that the mortgage company charged the borrower for doing the loan, for causing it to come about, hence the term origination. The second sentence says, when a home loan is originated, a loan origination fee or a transfer fee is charged by most lenders to cover the expenses involved in generating the loan. Typically, it is going to be around 1% of the loan amount. They tell you that in the very last part of that paragraph. I want you to know that typically the origination fee will be 1%. It could be 0. It could be 0.5%. It could be, rarely is it more than 1%. But it is a negotiable closing cost. On page 212, you see discount points. I want you to highlight that first sentence because they could have a very simple question on the state exam that says, what are discount points for? And the answer would be to increase the lender's yield spread, or they say just yield. Yield is a fancy word of for profit. Here's what a discount point is. You may have this question. Yeah, you will have the question. Okay. If you'll just listen to me and try not to take any notes during this little piece of instruction because you're not going to know where I'm going with this. And I'm going to be all over the place. But lenders charge a fixed rate for money. It's always relative to what they had to pay for the money. In a manner of speaking, it's similar to any other business. If I owned a hardware store and I paid $1.50 for hammers from a manufacturer, I would probably mark them up and sell them for $4 in my store. That means I'm making $2.50, right? I pay $1.50. I sell them for $4. I make $2.50. Same thing. I'm a mortgage lender. I might pay 3% for money and then mark it up 2 and sell it to the public for 5%. I get the difference of 2%. So the interest rate is determined by the mortgage lender. But there's a formula, y'all, and again, don't write this down. There's a formula that determines how much you and I can borrow. The interest rate of the loan in question, the term of the loan in question, my income, and my debt. These 4 ingredients. You do not need to write this down. You do not need to know that on the state exam. But these 4 ingredients determine how much I can afford to borrow. So let's say I have seen a $100,000 house and I'm going to put $5,000 down. I've got that much saved up. So that means I'm going to be needing to borrow $95,000. So I go into the mortgage lender and I say, hey, Red Apple Mortgage Company, I've got my eyes on a home. I'm under contract with them. In fact, it's a $100,000 home, and I'm wanting to put $5,000, so I'm needing to borrow $95,000. And the mortgage lender says, "Well, have a seat, sir. I'll get you a cup of coffee, and let's start crunching your numbers and see if we can get you qualified." So they ask me, "How much do you make, sir? What's your monthly obligations, sir?" And they run it through a formula. And they also, "What kind of mortgage you want, Mr. Yarbrough? You want an adjustable rate?" "No, I want a fixed rate," I say. So we've got that. And he said, "Mr. Yarbrough, my rate on 30-year fixed money is 4.5%. That's what I'm selling it for." Let's say this is 5, and this is 6, and this is 4. Okay, to the consumer, 1% of interest, this is 4 and this is 5, is cut up into eighths. Now, we broke stuff down, learned how to break stuff down in school. 4 and 2/8 would be 4 and 1/4, right? Like 4/8 right here, that would be 4 1/2. Like 6/8 right here, that would be 4 3/4. But then you got to know how to write an eighth with a decimal. So to write 4 and an eighth, that is the equivalent of 4.125, because 1/8 equals 0.125. Okay, so to write 4 and 2/8, what is that? That's the same as 4 1/4, right? And that would be spelled 4 1/4 with a decimal. That would be written just like it sounds, 4 1/4. So what if I got 4 3/8? How did that damn 3 turn into a 7? 4 3/8, all I do is add 125. So 4 3/8 would be 4.375. Okay? I don't know if you're going to have to do this on the exam, but here's the thing. I walk into the mortgage company. He says, Mr. Yarbrough, I'm selling the money at 4.5%, but I've run your income and I've run your debt through the machine, and you can't qualify for this mortgage at 4.5. You need 4 1/4. I say, but you're charging 4.5. How am I going to get it at 4 1/4? He says, Mr. Yarbrough, you can buy discount points. I say, is that right? He says, that's right. He says, if you buy one discount point, we can give you an eighth of a point cheaper. I said, but you said I need 4 1/4. That's 2/8 cheaper. Do y'all see that? 4 2/8 and 4 4/8. So how many discount points do I need to buy? I need to buy 2 discount points because I need to buy 1/4 of a point. Okay? Now, here's the thing. I have to pay for that at closing. So at closing, I'm paying my down payment. I'm paying my closing costs. Now here I got to pay for the discount point. 1 discount point equals 1% of the loan amount. What am I wanting to borrow? $95,000. What's 1% of that? $950. How many do I need to buy? I need to buy 2. So at the closing, in addition to my down payment and closing costs, I will write them a check for $1,900, effectively buying the rate to 4.5. Huh? Yes, you can always buy discount points. But here's the thing. Would there be a difference in the monthly payment on a 4.5% loan versus a 4 1/4? There would. In 30 years, that's the difference. You get it? So I'm giving them the difference in the interest rates in cash up front. So now they're not going to get it monthly throughout time. They're going to get it all up front. So just know, more than likely, you're going to have a question that says Mark is about borrowing 95. No, they'll tell you Mark is buying a $100,000 house and he's putting $5,000 down, and he's got to buy 2 discount points. How much is each discount point? They want you to remember this, that 1 discount point is worth 1% of the loan amount. They're going to want you to think, they're going to have an answer choice of 1,000 because the purchase price was 100,000. They're going to test to see if you remember that it's 1% of the loan amount, not the purchase price. Discount point, because the loan has nothing to do with the damn value of the home, does it? They just want a piece of the loan, that's all. So really, more than likely, that's what you're going to need to know, that 1 discount point equals 1% of the loan amount. That's how much it's going to cost you at closing. Now, again, some of you absorbed that and said, I have no problem with that. I'm going to get that. Half my class was nodding their head. The other half wasn't. That's normal. If this doesn't make sense to you, Do not think that this is going to prevent you from passing the exam. This is just one of your 42 questions that you're going to miss. Big deal. Because out of 140 to make a 70%, all you got to get is 98 right. You can miss 42 questions. Doesn't that sound like a lot? That's a lot of French fries. You can miss 42 questions. I don't know anybody that's ever made 100. And guys, a lot of times it sounds like I'm kidding, but your mindset from beginning to end is so important. And people get scared, they get intimidated, they get nervous, they get anxious, and that affects your performance. You can't let that. When you see this question, if you're one of those persons that ain't gifted with math, just look at it and say, "You bastards. Y'all might have got me on this one, you know." And then just take a damn guess. You got 4 choices. Guess one of them and move on. But don't you let the one question throw your mind off. All right, here we go. We are still on page 212, and in the middle of the page, we talk about, well, look, prepayment penalty. Look right above prepayment penalty. They give you an example of 2.65 discount points. I was using whole numbers, but that's easy. I would just take the loan amount of $350,000 and multiply it times 2.65%. That's all. I just wanted to show you that to let you know the discount point might not just be a whole number. Could be a little fraction like that. In the middle of the page, you see prepayment penalty, and prepayment penalty is self-explanatory. If you pay the loan off before its term, you have prepaid it. Therefore, the lender, a lot of lenders on a lot of different kinds of loans, will charge you a prepayment penalty. Why? Because when you came into my bank wanting to borrow money to buy this car, and you asked me for a 5-year note, I, as the bank, was anticipating making 5 years worth of interest on this loan. So if you want to trade it in after 2 years, I'm not going to make 3 years worth of interest that I was hoping to make. Therefore, I'm going to charge you a penalty for paying it off soon. Because you know what businesses have to do? Publicly owned businesses, meaning people own stock in them, they have to make annual projections at the beginning of the year. What do you think a bank's annual projections are based on? The terms of the loans that are in place. Do you see where I'm coming from? And if I'm making annual projections based on the terms of the loan and people are paying the loans off before the term, my income gonna be off, you know? So they have to charge prepayment penalties to make up the difference, if you will, and to frankly to discourage you from paying it off, you know. But most mortgage loans, your FHA, your VAs, your conventional, they do not charge the borrower a prepayment penalty. We'll talk about that more than once throughout tonight and tomorrow. Tomorrow night. So prepayment penalty, and it does have to be disclosed, and you see above the bold prepayment penalty that there is a prepayment clause that you would be pointed out at the closing. Security instruments. Let's talk about this for a second. And before we talk about security instruments, let me talk about this. Let's say I want to go to Wells Fargo Bank. I want to start me a biz. Maybe a little landscaping biz. You know what I need? I need a trailer. I need some weed eaters. I need some lawnmowers. I need some blowers. I need landscaping, stuff. So let's say I'll go into Wells Fargo wanting to borrow $50,000. They're going to make sure I got a job. They're going to make sure I got my credit in line and all that. But before they cut me a check, they're going to say, "Mr. Yarbrough, have you got something in your world worth $50,000 that we can hold on to while this loan is outstanding?" And y'all know what I'm talking about. I'm talking about collateral. "Mr. Yarbrough, do you got any stock worth $50,000? You got any other real estate worth $50,000? You got $50,000 in cash or a CD at the bank? You got something worth $50,000? Because we want to hold on to it." We all know what the purpose of collateral is. Basically, they're holding it hostage, right? Because they know to compel me to pay the loan back, they want something of mine, and they're going to hold it tight to the chest. they need peace of mind to go to sleep at night. They need to have some assurances that they're going to get paid back. And if I don't pay the loan back, they have something of equal value. So the depositors of the bank aren't harmed. But there are a lot of lending situations, y'all, where there is no collateral. Like a car loan. There's collateral, they just don't have physical possession of it. Like in a car loan, you driving around in the collateral. They don't have that same peace of mind at night. They got the peace of mind when they're holding it close to their chest. A mortgage loan, you live it in the collateral, right? So there's some financing where they can't have physical possession of your collateral. Therefore, they don't have that same peace of mind. And you know what peace of mind is also sometimes referred to as? Security. Like what's a blanket to a child sometimes? A security blanket makes them go to sleep, shut up. What's security to a grown person? A locked door, a gun. A security. Think of the word literally is what I'm trying to say. Because we know that in the modern day, some words have multiple contexts. Think of it in that way. Because think about it, if you had $100,000 left and you just lent it out to somebody, you'd be scared as hell as they rolled off of your money. You'd be like, God, I hope they pay me back. And they're lending a lot of money out multiple times every day. So they need that secure feeling to make them sleep good at night. So since there are some lending situations where they can't have physical possession of collateral, a security instrument was invented by the mortgage lending industry. Y'all, I've used this example before, but we'll use it again. Y'all can be very general and call me a human. You can get more specific and call me a man. You can get more specific and call me bald. You can get more specific and call me an a-hole. Whatever. Point is at the top of the totem pole is a human. And then you get a little more specific as you go down. So at the top of the totem pole in my scenario is a security instrument. That's the broadest term, like human. But there's specific kinds of security instruments, like boom, as we move down the totem pole, a lien. Like a man is a type of human, and there's more than one type. A lien is a type of security instrument. So you have security instrument at the top, lien at the bottom, and then you get more specific. A mortgage is a specific type of lien. Like a bald is a specific type of man. You get a little more specific as you go down the totem pole. Security instruments. You see on page 213. I don't know if you need to know this on the exam. I did. I don't know if they still test on it, but you can do one of two different things with collateral. You can pledge collateral or you can hypothecate collateral. You would hypothecate collateral in these lending instances that I'm referring to, like a mortgage or a car. In other words, when you hypothecate collateral, you keep possession of it. When you pledge collateral, you give up possession of it. Like I remember as a student, I had to know this on the exam, and I thought P for pledge reminded me of pawn shop. Because when maybe I got a hot date Friday night and I need $50. I ain't got $50, but I got a guitar. So I go to the pawn shop and I see, do y'all think this is worth $50? They say, sure. Are they going to let me keep the damn guitar? No. There's a reason that pawn shops have a lot of damn guitars. Have you ever noticed? A lot of musical instruments at pawn shops. A lot of tools. So that's the thinking. When you pledge collateral, you give up possession like a pawn shop. When you hypothecate it, you keep possession like a car. Moving down, you see mortgage. And guys, you've heard me tell y'all before that regionalism has caused different words for food, different words for culture, different words for everything, including real estate. And there's different foods. We eat grits, others eat cream of wheat. Weird folks. They're almost the same thing when you think about it. They're both white. They're both typically eaten for breakfast. Just regionalism is the reason there's there. So we tend to eat grits in the South. We tend to use mortgages in the South. When you turn the page, you see at the top of page 214 that some states use deeds of trust. That would be cream of wheat. You know, and guys, you can even put in parentheses my little teaching examples. You can put cream of wheat above deed of trust and grits beside mortgage because it's the same thing, just slight variations of each other. Now, a deed of trust is sometimes called a trust deed. And I bet you we have students either in the satellite classrooms or my classroom who have come from a state. Is there anybody in my room who's come from a state that uses a deed of trust or a trustee? They tend to be out. You did, dear. What state, if I may ask? Pennsylvania. I was going to say in the Northeast and out west, California, like they tend to use trust deeds. In the Midwest and the South, we tend to use mortgages for whatever reason. Now, if we'll turn back to page 213, let's talk about a mortgage real quick. First of all, a mortgage is a lien. We talked about that. And you'll notice in the paragraph that there's two parties in a mortgage. One's referred to as the mortgagor, one refers to as the mortgagee. Now, there's a bunch of ors and es in real estate. We talk about them. The one of the ors and es that is most misunderstood more often than not is mortgagor and mortgagee. And here's the reason why. Because we as lay people confuse money with the security instrument. I don't make a mortgage payment. I make a note payment. That's an example of that too. Also, ask the seller. You know, if somebody I'm as guilty as the next layperson. If somebody called me today, a friend, and said, "Mark, we just bought a house," I'd say, "Where you go get your mortgage?" You don't go to a mortgage company to get a mortgage. What do you go to a mortgage company to get? Money. You're buying property. Ask the seller what he wants. He's going to tell you a dollar amount. He ain't going to tell you no damn mortgage. I want $672,000. He ain't going to say mortgage. So we technically go to a lender to get to get money. Technically, we exchange. We say, here is a mortgage. Here's a legal document giving you permission to foreclose on the property if I default on the promise to pay, and you give me the check. It's a trade-off. I give the mortgage lender the mortgage. They give me the money. It's a trade-off. So if I'm giving the lender the mortgage, what does that make me the borrower? The mortgagor. And that's contrary to what you have probably thought most of your life. The borrower is the mortgagor. The lender is the mortgagee. So again, of all the ors and es, if you have always thought that, you are very normal. I had always thought that as well prior to taking this class. So, mortgage, we define the fact that there's two parties, mortgagor, mortgagee. Think of the way a borrower sound when you say the word borrower, mortgagor. They sound similar. Now, look right there in the next paragraph and highlight where it says lien theory state. And then come over here to page 214. And in the second paragraph, highlight in the second paragraph, title theory state. Before I distinguish lien theory from title theory, let me talk about the first paragraph. And then we'll take our first break. I told y'all a mortgage has two parties, mortgagor and mortgagee. A trust deed situation, sometimes called a deed of trust, has three parties. Much like mortgagor and mortgagee, there's a trustor and a trustee. But then there's a third party called the beneficiary. So here's what we're going to get down. Both ors are borrowers. Trustor is a borrower. Mortgagor is a borrower. So we got that down. There'll be probably 2 questions, 3 questions where you need to distinguish who these people are, who the players are. So both ors are borrowers, but the trustee ain't the lender like the mortgagee is. The beneficiary is the lender. Where do you see that in the first paragraph? Well, who's the trustee, Mark? They don't even got the damn trustee with bold print. The trustee is an uninterested party. When I say uninterested, I don't mean bored. I mean somebody who don't have an interest in the property. Kind of like if I'm selling a car on Craigslist, a used car, and you respond to the Craigslist ad, and I say, well, meet me at Shoney's. I'll let you drive it around the parking lot. I'll let you kick the tires. And if you want to buy it, I got a booth in the back of Shoney's reserved. We'll go type the paperwork and exchange money. Shoney's would be the trustee. It's a business that has no interest in the transaction itself where the transaction is taking place. Do y'all follow that thinking? Typically, a trustee is a title insurance company. But just know that the beneficiary is the lender and both ors are borrowers, mortgagor, trustor. Now I'm going to define legal theory and title theory when we come back from break. I have 7 o'clock. Let's take a break until 7:12. So in case it flips over, you'll get a full 11-minute break. I'll stand up and enjoy the break. Go outside and talk. Go smoke. Go to the restroom. You've been working hard, relax. Okay, hopefully everybody is back from break, and we're going to pick up where we left off. And gang, we left off on, yeah, let's turn back to page 213. You see that lien theory, I asked you to highlight it. And then when you turn to page 214, you see title theory. I asked you to highlight that. So let's talk about that. Again, grits and cream of wheat. Some states are lien theory, some states are title theory. Here's what I want you to know. On page 213 in the left-hand margin of where you highlighted lien theory, put borrower has legal title. We're on page 213 in the left-hand margin of lien theory where you highlighted that. Just write borrower has legal title. And then turn to page 214, and in the left-hand margin, right to the left of where you highlighted title theory, put lender has legal title. I'm going to explain after you write. Lender has legal title. Y'all, here's a true fact. I have a couple of guy friends, and they know cars. They know how to take them apart, put them back together. They know how to soup them up. And I don't know anything about cars. And when we're out drinking, they call me girl names and stuff. But now they'll get off on a conversation, and if they get to talk about cars, I'm like, well, I got to just sit here and drink by my damn self for 15 minutes. You know, I can't participate in the conversation. But they're talking about, Ford's 3.7 and a BMW's, All I know is when I get in them, there's two pedals down there, and I push the one on the right, I move forward, and I push the one in the middle, and I tend to come to a stop. I'm trying to make a point. You do not have to know who has legal damn title in different mortgage situations to make a living selling real estate. I know I keep making that point to y'all here and there, but I just remember I'm empathetic. I remember being y'all and being a pre-licensed student, and every class I'm like, hey, I got to know this crap too. No, you don't. We just got to pass a test and then get into business and sell bathrooms and bedrooms and backyards. So, it's kind of like this as far as here's the thing. Even though the specs are different from a Ford and Chevy, to a naive driver who doesn't know anything about cars, you wouldn't be able to discern a difference between the two, would you? But there are differences under the hood, aren't there? That's the thinking. I don't care. Regionalism has caused different ways of doing the same damn thing. I don't care if you're in a lien theory state or a title theory state. If you don't make your mortgage payments, they're going to take your damn house. Okay? Just like in any car, you press the right pedal, you move forward, you press the middle, and you tend to slow down. So don't get bothered by all this. We just need to know it one magical day, pass the exam, and then go deal with real people, not nerds. But I do want you to know that, what I just told you, that in a lien theory state, I done lost myself. Gosh. Here we go. Let me write that down. Okie dokie. Let's turn to page 215. Duties of the borrower. I've given you this example before, but there's more than one reason you can get evicted, right? You can get evicted for growing stuff, in the closet. You can get evicted for having an RV taking up 12 spaces on blocks. You get evicted for partying and, playing your rock and roll music and the police getting called. But the majority of the time, I think y'all would agree with me that the reason people get evicted is because they ain't got the rent money. And that same thinking applies to mortgages. There's not making your mortgage payment is the primary reason people lose their home to foreclosure, but there are other reasons you can lose your property to foreclosure, just like we used as an example with renting. And that's why I say the promissory note, figuratively speaking, is stapled to the mortgage. It repeats the promises within the promissory note and then includes a few additional promises that the borrower is making. So we see duties of the borrower in the middle of page 215. The borrower is required to fulfill certain obligations created by the mortgage or deed of trust, and this includes payment of the debt in accordance with the terms of the promissory note, payment of all real estate taxes on the property, maintenance of adequate insurance. You got to have, just like a car, you got to have insurance. Maintenance of the property in good repair at all times, and then authorization from your mortgage company to make significant alterations to the property. So not making your mortgage payment is not the only reason you can lose your property to foreclosure. They give you some other reasons. But now we're going to talk about some. No, we're not. Okay.
Hey, Mark.
Yes.
Can you give an example of the maintenance of the property and good repair at all times?
I can't. Well, you let the property go to hell. Here, one of my students said, Mark, could you give us an example of that next to last bullet? Maintenance of the property and good repair at all times. You know what? While that's a legitimate question, I only teach this crap. The only reason I know anybody's ever lost their property to foreclosure is not making their mortgage payments. Yeah. I only know this because it's in a book and I'm required to teach it to you. Now, when you default is not just not making the mortgage payments. Default is not doing something that you weren't supposed to do. So provisions for default, the mortgage or deed of trust typically includes an acceleration clause to assist the lender in foreclosure. If the borrower defaults, the lender has the right to accelerate the maturity of the debt. This means the lender may declare the entire balance due. So, it says that without an acceleration clause, the lender would have to sue the borrower every time a payment was overdue. So if you violate some reason, one of those 5 bullets, if you do something wrong, the mortgage company is going to send you a letter saying, Mr. Yarbrough, you have defaulted. Therefore, we want the entire balance of $176,219.42 due immediately. Now, if you ain't made your mortgage payment, do they think you have that much money? Frankly, they're not concerned with whether you have that much money or not. It's a formality. When you get the letter, they're just trying to tell you, Mr. Yarbrough, when you missed a few payments, we tried to work things out with you, but you ignored our phone calls, and now the foreclosure machine has been turned on, and there ain't no dickering your way out of it. So when they accelerate the debt, again, it's really just a formality. They're just telling you it's on, and there ain't no going back. The foreclosure process has begun. They're accelerating the debt. All right, so here we go to page 216. The top of the page, assignment of the mortgage. We talked about an assignment in a previous chapter. We said an assignment is a generic word that applies to all contracts. It is where one person who's involved in a set of obligations transfers their responsibilities to another person. Someone assumes another person's obligations in an agreement. An assignment has taken place. Any contract can be assigned. So what if I have a home that's paid for and I'm selling it and a young couple want to buy it from me and they say, Mr. Yarbrough, we haven't established credit. We're too young. Will you own or finance? I say, yes, I'll own or finance. I'm trying to remember what the point of what I'm talking about is. Yes, I'll own or finance. So we agreed that they're going to pay me $746 a month for 30 years. Well, they paid me $746 a month for 5 years, and now I want the balance of the damn mortgage. I'm tired of just getting $746 a month. I want the $74,000 balance. Why? Because me and the old lady want to go to Fiji, and $746 is trickling in too slow. So I don't know if you've ever read the classifieds and seen an ad that says, I buy mortgages. Debt is bought and sold. We established that fact at the beginning. beginning of the class. Somebody may see that ad in the classifieds, call me up and say, I'll buy your mortgage from you. I'm going to have to sell it for less than what's owed because nobody would want to buy it. But nevertheless, I can get out from under a note that I agreed to tote. Okay, and me and you would say, I sold my mortgage. Nerds would say, you assigned your mortgage. Okay, so an assignment of a mortgage is just what I sell a mortgage balance to another man. And just like I would endorse a check to another man. On page 216, in the middle of the page, you see release of the mortgage lien or deed of trust. I think it's pretty understandable that when you pay a debt off, especially one where there's a lien, you want the record to reflect such. And if there's a lien associated with it, you want the lien removed. That's self-explanatory. So in this, you see in the middle of the page, there are two paragraphs. Under release of the mortgage, lien, or deed of trust, there are two paragraphs. In the first paragraph, look at the third line, go to the end of the third line, and highlight by the provisions of the defeasance clause, and then in the line below that. So highlight by the provisions of the defeasance clause in the financing instrument, the lender is required to execute a satisfaction of mortgage when the note has been fully paid. That's what I want you to highlight. I used to always wonder why my dad was always burping in conversation. I haven't eaten since breakfast, and I'm sitting here. You'd think I just ate an hour ago. It's ticking me off. All right. Here's the thing. To the left of what you just highlighted, I want you to write the word mortgage. I'm going to tell you why in just a second. Go to the next paragraph, and on the next paragraph, the third line, highlight the sentence that begins, the trustee executes and delivers a deed of reconveyance, sometimes called a release deed, to the trustor. In the left-hand margin of that page, to the left of that where you just highlighted, write trustee. Trust deed. Trust deed. You know, the damn thing we've been talking about tonight. Trust deed. Now, y'all, look at the paragraph where I asked you to write mortgage in the left-hand margin. You see there's a defeasance clause, the word defeasance deriving from the word defeat. And basically the defeasance clause in a mortgage is language that says something like this. Hey, Mark, when you make your last payment to us and pay this balance off, we're out of here. Our interest in the property has been defeated. It's all you. You own it free and clear. That's the purpose of the word defeat. Our interest has been defeated. It's all you, Mark. You owe it free and clear. But that's not what I want you to know. What I want you to know is the defeasance clause requires the lender to file satisfaction when you pay it off. Meaning, if they fail to, they could be liable for any damages. And what damages? Well, if you've got a damn lien showing up on your credit, that could affect your ability to get other financing. You know, so all I want you to know is the defeasance clause is in a mortgage, and it requires the lender to file satisfaction when the balance is paid in full. If it's a trust deed, the trustee executes and delivers to the borrower a deed of reconveyance. Again, one's grits, one's cream of wheat. Same thing, just different parts of the country. The thought is the same behind both. Once the person in a trust deed makes the final payment and the balance is paid off, the interest reconveys whatever interest they had back to the borrower, because now the borrower owns it free and clear. It's just different words because of different parts of the country. So we want to associate a defeasance clause with a mortgage and a reconveyance deed with a trust deed. Over here on page 217, Well, we're talking about real estate financing, and I did casually skip the bottom of page 216. Let's go down to the bottom of page 216. Guys, lenders, I just told y'all a second ago, and some of y'all, most of y'all knew it, and some of you didn't, where I put up on the board and I said that when we make our mortgage payment, it includes principal, interest, taxes, and insurance. You only scratch one amount into the box on your check, but little do you know, you're paying off four different things. You're reducing the loan, that's the principal. A portion of your monthly mortgage payment is interest, that's what the lender earns. A portion of it is 1/12 of your property taxes, and a portion of your one payment is 1/12 of your homeowner's insurance. You know, people are strange. People will pay monthly for something all day long, but they won't pay a big annual fee. You know, you'll be like, this TV is $600. And you're like, oh, hell no. And you're like, but only $50 a month. Well, okay. You know, they won't pay the 600, but they'll pay the $50 a month, you know. Well, if I'm a mortgage lender and I've lent you money to buy a home and now you ain't paying your taxes or you didn't pay your insurance and now the property's burnt down because there was a fire and I'm owed 200,000, scientists have determined borrowers tend to stop making mortgage payments on burning piles of rubble. So, since the lender can't trust that the borrower will pay their annual taxes and annual insurance, they assume that responsibility for you. So that's why they take your annual tax bill and they make it into 12 parts and make one part a part of every monthly payment. So every month you send your mortgage payment in, they pull the tax part out, and they drop that in a tax escrow account. They pull the insurance out of your payment, they pull that in an insurance escrow account. They do that every month. At the end of the year, they've got 12 contributions. So they pay your taxes for you. You ain't even got to fool with it. They pay your insurance for you. You ain't even got to fool with it. They handle it for you. But that's what they're talking about. They have to, after closing, set up an escrow account for your tax and insurance. Same thing, top of page 217, you may live in a floodplain. If you do, there's going to be flood insurance. Same thing. There would be a fifth component to your monthly payment, and it would be 1/12 of whatever your flood insurance premium would be. So now in the middle of page 217, we're going to talk about assuming another person's mortgage or deed of trust. Frankly, it doesn't happen. They pretty much made assumptions extinct in the mid 80s by changing the rules because lenders figured it out. If I could assume your loan and you could assume the person you're buying the homes for loan from, who's left out in the cold? The mortgage companies are. They're not getting played with. So they basically changed the rules to prevent assumptions from taking place to force us to borrow money. But nevertheless, it is still conceptually possible to assume someone's debt. So they test you on it still. So in the middle of the page, I'm going to put it on the whiteboard. There's two kinds of assumptions. The first kind of assumption is merely called an assumption. The second kind of assumption is called a subject to assumption. On a regular assumption, and this is what you should write, this is what you're going to need to know on the exam. On a regular assumption, seller remains secondarily liable. Seller remains secondarily liable. I'm going to talk while you write. The person who assumes your mortgage, the buyer, is primarily liable. And rightfully so, right? You're assuming my debt. By God, you should be primarily liable for it. But here's the thinking behind the seller being secondarily liable. If the person that I let assume my mortgage 5 years down the road drops the ball financially, If the mortgage company can't squeeze any blood out of their turnip, they're going to come hunting the original party of the loan down. They're going to try to squeeze some blood from my turnip. Okay? So that's the thinking behind that. On a subject two, this is going to sound terribly unfair to the seller, and it is. I don't know any of y'all personally. I don't know what you know about mortgage history and real estate history, but in 1980, interest rates went from 10.5 to 23%. Like right now, mortgage interest rates are at about 4.5%. I'll tell you the difference. You want to buy a garden home, spend $125,000 at 4.5. Your principal and interest payment would be $633 on a $125,000 loan. At 23% interest, your payment's $23.98. Yeah, the reason interest rates did not go sky high this time, the last recession, is the Federal Reserve invented a concept called give me a second. Son of a gun. It's not important. I'm just bothered because I can't remember crap. Can't remember my own name twice a day. Oh, it flashed right there in front of my head. Anyway, basically we were printing money. We didn't invent anything. We just gave it a fancy name. We knew that if the interest rates went sky high, that the economy was already so bad that it would become terrible. So, oh my gosh, just right there on the tip of my tongue. Who cares? Quantitative easing. Who said that? Mr. Smarty Pants. I'll be damned. How about that? Did you look that up or you just know? No, I know it like the back of my hand. It's like not knowing quantitative easing is like not knowing my mother's name. Quantitative easing is the name. Again, you don't need to know that for the exam. It was just bugging me. I had to remember it. But then, nevertheless, quantitative easing kept interest rates down low. But here's the thing. If in 1981, I got to sell my house because I just got a job transfer to Akron, Ohio, and the interest rate's at 23, you know what happens when the interest rate's at 23? Nobody buys houses. So here I am trying to sell my house, and if I don't get to Akron in a certain period of time, I'm going to lose my damn job. Am I a desperate seller? Yes. So there's some creative financing that is meant to take advantage of desperate sellers in desperate periods of time, and this is one of them. Let's say it's 1981, the interest rates have popped to 23%, but I'm a veteran and I bought my home 10 years ago and I've got a VA loan with a balance of $140,000 financed at 7.5%. And the borrowers say, Mr. Yarbrough, can we assume your loan? Because 7.5 is better than 23. Y'all think so? I say, yeah. And they say, well, we want to assume it's subject to. And I say, oh, hell no. Subject to means I, the seller, remain primarily liable for the debt until it's extinguished. You mean the person that assumed the debt is not primarily liable, Mr. Yarbrough? That's exactly what I'm saying, rural person. I remain primarily liable for the debt. I want you to know these distinctions. Who is primarily liable? Who is secondarily liable? I told you here. Buyer primarily liable, seller secondarily liable. Here, seller is primarily liable. And that's all you got to know. wouldn't want to be. Beggars can't be choosers. Okay. One of my students says, why would the seller be liable? Let's say my daughter is 19 and she has no credit and she asked me to sign for her for a car. She's driving around in the car, but who's primarily liable for the debt? Me, the daddy. Same thing. Even though I'm moving out of the house and letting you move in, and even though you're going to pick up the payments and make my monthly payments, if you drop the ball down the road financially, they're coming after me and not the person that I let assume my mortgage.
Okay, so assuming a mortgage is not the same as buying a house.
Well, it can be. Assume I have a couple of students who are asking questions about assumptions. It'd be like you don't see this anymore, but you used to see somebody selling a car and they would ask somebody to pick up the payments. You'd see it in the newspaper. Somebody won't pick up the payments. Well, in other words, they got 2.5 years left. They're making a $279 a month payment. Maybe they lost their job, and before their credit is affected and they lose the car, they're wanting somebody to come pick up the payments. Same thing. It'd be where I'm in a home, I'm in a loan, I'm making a monthly payment. Someone says, Mr. Yarbrough, can I pick up your payments? They're basically stepping in to where I was, and now they're making the monthly payments on the loan. Now, hold on. If there's any equity in the property, the person assuming the other person's loan has to write a check for your equity. So if I've got $40,000 worth of equity in the property, for you to assume my loan, you've also got to pay me my equity. Yes, sir. Yeah, I'm getting some real curious questions that you're not going to have to know in the exam. But okay, no, that's okay. If right here, let's say we're on a subject. I'm the seller of a home, and I've got that mortgage. And someone says, Mr. Yarbrough, can we assume your mortgage? I say, yeah. I tell them how much equity I have. They stroke me a check. They come into the house and begin making the same monthly payment that I had been. Down the road, they miss 3 payments in a row. The lender will foreclose, put them out, but I'm the one with the blemish on the credit. See what I'm saying? So I'm the one whose name is on the loan. They get foreclosed on. They got to move from the house. Don't get me wrong. It's just I'm the one that gets the blemish. So at the bottom of page 217 is an alienation clause. And an alienation clause is go look at the third line down. I want you to go into that, and I want you to highlight due on sale clause. They'll either refer to it as the alienation clause or a due on sale clause. Now, everybody listen to me, knows that if you have a car, and let's say you got 3 years left on your note, and you're making a payment of $279 a month. You got 3 years left on your note. You got a 5-year note when you bought it. You paid on it for 2 years. You got 3 years left on the note. But here comes the 2019 models, and they're sharp. And the grass is greener on the other side. I start thinking, I'm going to trade my car in and get me a new car. So when I go to the car lot, what's the first thing me and the car lot have to negotiate? Payoff. What are you going to give me on my car? Let's say I owe $8,000 on it, and they say, we'll give you $8,100. That's good. Are they going to write the payoff check to Mark Yarbrough? Or are they going to write it to my bank who I owe the money to? They're going to write the payoff check to the bank. I can't get the payoff. Real estate is the same way. If I'm selling my house and I'm the owner, at the closing, I have to pay my mortgage balance off. I can't get the purchase check from the buyer, put that in my pocket and walk away still owing $1,172.16 a month. I got to pay the mortgage balance off at the closing, just like a car trade-in. But let's say I didn't. Let's say I sold my house to somebody and I didn't pay off my mortgage company. And they find out down the road. They're going to send me a letter saying, Mark, we heard that you sold the daggum house and transferred title to somebody else, and you didn't include us. You didn't pay us off. You alienated us at the closing. You didn't pay the balance that was due on the sale of the property. See, due on sale clause is the more self-explanatory of the two. Alienation's kind of a nerd word. But it makes sense. You didn't include us at the closing. You didn't pay the balance that was due. You didn't pay the balance that was due on the sale. So guess what they're going to do? Therefore, you defaulted, Mr. Yarbrough, so we want the entire balance of $172,619.42. Anytime you default, whether it's not making the mortgage payments, whether it's not keeping the property in adequate, condition, whether it's making significant alterations without lender authorization, whether it's not paying, whether it's not, if I default for whatever reason, they're going to accelerate the debt. Any reason I default, they're going to accelerate the debt. They're going to send me a letter saying, Mark, we want $172,619.42. The alienation clause, they're going to accelerate the debt. Let's turn the page. Y'all want you to turn that fan on? They're working on the air conditioning in my building. It was freezing here for the first hour. Now we've gotten all stuffy again. So I'm asking my class if they're okay or about to pass out or what. Page 218. I'm hot. Just a little air moving around. Better than anything. Top half of the page we're not concerned with. They say that about every chapter. They talk about recording this and establishing your priority. Second half of the page, we're going to start talking about some different kinds of financing. The straight loan. Now, me and you would call it an interest-only loan. Nerds are going to call it a straight loan or a term loan. Here's what that is. Let's say I'm wanting to open up me a business, a coffee shop in a shopping center. I need me 4 industrially sized copiers, screen printers, stuff all like that. So I need to borrow $20,000. I go to the bank and they say, Mr. Yarbrough, we'll let you borrow that $20,000 on a 1-year note, interest only at 10%. Now, 10% of $20,000 is $2,000. How many months are in a year? 12. So I divide 2,000 by 12. 2,000 by 12. That's 166.67 a month. So I make this payment every month for 12 months, and at the end of the 12 months, they say, Mr. Yarbrough, you got the $20,000 that we lent you? See, I only paid interest every month. Do you see that? Now, you may be thinking, why would somebody get a foolish interest-only loan like that? I needed the $20,000 to get the equipment to run a business. Now that I've got a business, I'm earning money, so I can earn this money, save it, and pay it back at the end of the year. And often, on an interest-only loan, you get a very attractive interest rate. So, but guys, back in the day, see, most of y'all are familiar with amortized loans. Like if you have a car payment right now, that's an amortized loan. A portion of your monthly payment is principal, a portion of it is interest. So at the end of a term, the loan is extinguished. It's predictable. But back in the day, y'all, Amortized loans didn't exist, and banks only lent money out on an interest-only basis. I'm going to tell y'all this tomorrow night, but back in the 30s, you could only get mortgage financing for 5 years, interest only. And if you've ever fallen victim to the car title pawn circus, then you know exactly what an interest-only loan is. You chasing your damn tail. You're just making an interest payment every month. That's all. And then, and you're never reducing the actual amount that you owe. So straight loans were normal loans to our grandparents. You know, and when the amortized loan came about, it was a gift from God. Because at the end of a term, without me having to have the discipline to save money, I knew if I made my payment every month, that loan would be extinguished. And that was the beauty of the amortized loan, because it addressed our inability from a discipline standpoint to set aside money to pay the loan back on an interest-only loan. On page 219, we're going to talk about an adjustable rate mortgage. An adjustable rate mortgage does exactly what it suggests it's going to do. It adjusts periodically. It's not arbitrary what the adjustment is, though. It's not random. There is a method to the madness. And there are different kinds of adjustable rate mortgages. Some adjust quarterly, some adjust biannually. Some will be fixed for a period of time, like 3 years, and then adjust annually after that. But the most common adjustable rate mortgage is an adjustable rate mortgage that adjusts annually. Therefore, it has a birthday just like you and I. And on its birthday is when it adjusts. Its birthday is established by closing, whenever you close on the loan. You can adjust up or down. Here's the two ingredients that are added together every birthday of the mortgage to determine the new rate. A margin added together to an index. So here, let me give you an example. When you hear margin, think profit margin. I gave you an example a second ago. Just like a hardware store owner, if I'm a mortgage lender, I might pay 3% for money and mark it up and sell it to the public at 5%. My margin is 2% in that little scenario. I pay 3 for the money, I mark it up 2, I sell it for 5 to the public. So in my scenario, the margin's going to be 2. I just have to come up with one number to give you an example. The margin could be 2.5, 3.25, 4.5, whatever. I'm just coming up with a number to give you an example. An index is an inflationary indicator. Didn't I give you all an example of what a consumer price index is? Like if I bought the same 10 items at the grocery store every single day, I would see the cost of that basket go up over time. Like I buy the same 10 items at the grocery store and they're $42.13 this week. They're $42.17 next week. They're $42.23 the week after. What am I seeing? The rate of inflation. The cost of goods and services going up over a period of time. So the mortgage would be tied to some inflationary indicator, and they call those indexes, like the consumer price index. So let's say I go to a mortgage company and they give me 2.5% for my first year in an adjustable rate mortgage. But then here it is 1 year later, and they say, Mr. Yarbrough, the index is 2.1, so your new rate is 4.1. See how I added the margin and the index? 2 plus 2.1. Your rate's 4.1 next year, Mark. Okay, a year later, the margin's 1.7. Mr. Yarbrough, your interest rate's 3.7. That's an example of it going down. And then a year later, this is 2.3. Mr. Yarbrough, your interest rate for the next year is 4.3. So the two questions that you might have on an adjustable rate mortgage are, what are the two ingredients added together to determine the new rate? Margin and index. They may ask you, of those two, Which of the two is fixed throughout the life of the loan? The margin. See, this changes every day like the temperature outside does. This was fixed at the time the loan agreement was signed, and it will never change. So we just probably helped you with two questions you may get on adjustable rate mortgages. You can cross growing equity mortgage down at the bottom. It's never been around in my entire adult life. They don't test on it anymore. Here's a mortgage amortization triangle. It's not that big of a deal, really. I got a little time. Here's how it works. You're probably going to have one of these questions on the exam. It looks more sophisticated than it is. But there is a way, I've just told you that your mortgage payment includes principal and interest. In the first 7 years of your mortgage, the majority of your monthly payment is interest. Do you want to know why? You really don't. I get that, but I'm going to tell you. Me and you, human beings, we have an average lifespan. What's our average lifespan? About 80 years, 79, 80, something like that. Well, a 30-year mortgage has an average lifespan of 6.3 years. People are either going to sell their home, satisfy that old mortgage, and get a new mortgage and a new home, or they're going to refinance. But 6.3 years is the average lifespan. So what I just told you is the reason that 90% of your monthly payment in the first 7 years is interest, because they want to make as much money as they can during the average lifespan of the loan. But the ratios of principal and interest change over time. After about 7 years, gradually your monthly payments become majority principal, little bit of interest, because the lender's already made the majority of their money up front in the first 7 years. So you could have a question that says, Mark just borrowed $100,000 at 5%, and his monthly payment is $416.67. Now, let's say that this doesn't include taxes and insurance, just principal and interest. The majority of that is interest. Some of it is principal. So what they'll do is they'll have a question, and they'll only give you this. They'll say, what is the principal portion of Mark's third mortgage payment? This is easy. Watch this. Well, 100,000 times 5% is $5,000 annual interest. $5,000 divided by 12 is 460. Oh man, I goofed this up. Damn it. The payment is $511. $511. That's the mortgage payment every month on this $100,000 loan at 5%. So we do the math. $100,000 times 5% is $5,000. $5,000 divided by 12. That means the interest portion of the $511 payment is $416.67, which means the difference is principal. And it looks like the difference would be 33 and 94. $94.33. This is interest. This is principal. They add up to give me my total monthly payment. So what's the principal portion of the second payment? Well, first of all, after I've made my first payment, let's say I just bought this house, I've made my first payment of $511. What is the balance of my mortgage now? Correct. It is $100,000 minus $94.33. So minus 94.33. That means 100,000 minus 9433 is 99,905.67. So you do this, what I just did up here and then did right there, you do it every single month. So now I say 99905.67 times 5%. And I get 499,528. Just like I got 5,000 right here. I divide it by 12 because that's how many months are in a year. And I get 416.27. So I subtract that from my monthly payment of 511 and I get 73.94. So this was the principal portion of my first monthly payment. This is the principal portion of my second monthly payment. And then what am I going to do with this? Subtract it from that and then multiply whatever the answer to that is by 5% and get that and divide it by 12. And you just keep doing that every single month. So they may have a monthly a question on your exam that says Mark borrowed 100,000 at 5%. His monthly payment's 511. What's the principal portion of his second monthly payment? And they're going to make you go through all of that. But again, I know you think it's cute and funny, but I'm just saying when you get to that question, if you know damn well you can't do it, you just go, you bastards, you got me again. And you just choose one of the four answers, the one that looks like it would be, and keep going, man. Don't you dare let them get y'all upset. Now let's take a break. I have 8:01. Let's take a break until 8:12. That gives us an 11-minute break. I'll see y'all back here in 8:12. Okay, the mortgage amortization triangle is on page 220 if you want to practice it, if you want to see if you could get it. If you were to get one of those questions on your exam, it would be one of your 13 math questions. Look on the next page. I used to have one of these in my billfold. We used to have to do a lot of business on the bumper of a car. You know, I mean, I'm not an old man, but things have changed drastically when it comes to hardware and software in our business over the last 20 years. And, you know, before we had the fancy real estate calculators that we've got now and stuff, we used to use this on page 221 to determine monthly payments. If you want to know how to figure out the monthly payment, all this is you would take loan amount divided by 1,000, whatever that is, you would multiply it times the factor. And that would give you the PI portion of your monthly payment. So for instance, it says Mark is buying a $200,000 house and he's getting a 90% LTV. What does that mean? What did I put down? I put 10%. What's 10% of 200,000? 20,000. So I'm borrowing 180. If you'll look right here, loan amount divided by 1,000. So 180 divided by 1,000 gives me 180. So what if it's a 5.5% loan for 30 years? Look at the page on the book. Find 5.5%. You see the rates are on the far left of the three columns. Look over to the 30-year term column. Bring your fingers horizontally and vertically together. And what do you get as a factor? So 180 times 5.68. I'll just go here now. No. The Dothan office that just signed on, your camera is not working. I believe that's Stephen. Stephen, the real estate commission requires me to be able to see inside the classroom. I need the camera working. I'm pretty sure that's your location. So 180 times 5.68 gives me 1,022. So 1,022.40. That would be a $200,000 house, putting 10% down. And they'll tell you that in the question at 5.5% for 30 years. All that information what the hell? Help me get all that. Because I had to subtract the 10% down to get 180. I divided by 180 by 1,000. Don't ask why. It's just necessary for the formula. It tells you that in the left-hand margin of the charts up there on page 221. Loan amount divided by 1,000 gives me that. And then you simply bring your fingers vertically and horizontally together relative to the interest rate and the term. And then that would give you the principal and interest portion of your monthly payment. Guys, y'all can experiment with this. When you're studying, you can think, wonder what my mortgage payment would be if I were to buy $1 million house. Let's do that for the hell of it. Some of y'all are like, I live in a damn $1 million house. Get off. That's what she said. the hell? My God, just made it bigger. Can't see nobody. I can see the mantle, but oh, for crying out loud. Get off! Yelling doesn't help. Well, son of a gun. We're just going to keep going with the damn stone fireplace up there. So, yeah, you got 1/12 of your taxes that would be added to that and 1/12 of your homeowner's insurance. But to get the principal and interest portion, you can use this chart. You don't have to have a fancy calculator. So let's see, if I borrowed $1 million, $1 million divided by, oh, yay, $1 million divided by 1,000. I should know that. Yes, 1,000. And 1,000 times 5.68. Not bad at all. $5,680. So $5,680 would be my interest rate on $1 million loan at 5.5% for 30 years. But the taxes would probably be $1,000 a month. You're about a $7,000-8,000 a month payment. Okay. A balloon payment loan, you don't see them with traditional lenders. They're typically between investors. They don't test on them. It's less information. I'm going to suggest that we skip it. When we come over here to page 222, I want you to cross reverse mortgage out. Exit out. They do not test on it any longer. Don't get me wrong. A reverse mortgage is a legitimate finance product. And if you're 62 or older and you're struggling financially and you own your home now, you may want to check into a reverse mortgage. It is a wonderful mortgage product for retired people, but they do not test on it any longer. Halfway down, page 222 is foreclosure. The first sentence does a good job of defining foreclosure. It's a legal procedure which the property pledges security for the debt is sold to satisfy the debt when the borrower defaults on any required payments or fails to fulfill any of the other obligations set forth in the mortgage or deed of trust. Over here on page 223, I want you to know on the exam about a judicial and a non-judicial, so you can highlight those. You're not going to need to know about a strict foreclosure or a deed in lieu. If you know what the word judicial means, that is our courts. So a judicial foreclosure, you could surmise, is a foreclosure that has to go through the courts. So a non-judicial foreclosure, using your powers of logic, is a foreclosure that doesn't have to go through the courts. You can circumvent the courts. You can go around it like a pothole. Now, I want you to, in the second line under non-judicial foreclosure, I'd like for you to highlight power of sale clause. Now, very few people read newspapers. I'm still hanging on. I still read my 3-day-a-week newspaper. And I'm going to read it until they stop printing the damn thing. It was just a part of my whole life for 25 years. Every morning I read a newspaper. But if you have read a newspaper and you see the classifieds, you've probably seen all the foreclosures listed. The law requires lenders to post homes that they're going to sell at a foreclosure sale for a number of days. There's always a section of the newspaper where those foreclosures are posted. In a judicial foreclosure, it can take months to get the people out of the house. A non-judicial foreclosure is not only one that can go around the courts, but the reason you would want to go around the courts is to do what? Speed it up. So as you would imagine, it's an expeditious foreclosure. And all they have to do is advertise the property in the paper for a number of days and then sell the property at a foreclosure sale and have you removed from the property by the sheriff. It's a way to do it very quickly. You typically don't see non-judicial foreclosures allowed with mortgages, and that's probably why I have never had a practical experience with one. I only know it because it's in books. Non-judicial foreclosures are typically associated with trust deeds. And you saw a lot of non-judicial foreclosures take place during the recession in California and out west. But I want you to associate the two. Power of sale. That means all they have to do to remedy their problem is post it for sale. If I ever ask you to marry two things together, it's because if one's in the question, the other's in the answer. If you see non-judicial foreclosure in the question, power of sale clause is going to be the answer. If you see power of sale clause in the question, non-judicial foreclosure is going to be the answer. So if you ever hear me ask you to marry two things together, it's for that reason. So I want you to associate those two together. On page 224, redemption. And you see a little illustration right there in the middle. You could unfortunately lose your property to foreclosure and get it back. Now, I'm going to put on the whiteboard what they have right there in the middle of the page, that little timeline. So you had date of default, sale, end of redemption. All right. So here is what the law calls a redemption period. So I default right here on the timeline, stop making my payments. They set the date of sale right here. So here's the thing. When I default right here, they're going to send me that letter saying, Mark, we want the entire balance of $172,649.42 immediately. And they tell me in the letter the date of the sale. If I can go get that money from somebody, maybe another foolish lender, or maybe my grandmother's wealthy and out of her mind and I'm just a piece of crap as a human being, so I go borrow it from my grandmother. You can tell I use actual cases in my life when I tell y'all about things. I know people who've gone and robbed their grandmother practically to avoid foreclosure. Nevertheless, if I go get the money somehow and I pay the mortgage company preventing this sale from taking place, I am said to have taken advantage of my equitable right of redemption. Don't write anything down yet. Let me get my chicken scratch up here, and I'll tell you how to write it down, because I'm on a power trip. Okay. If I go scrape up the money somehow and I give it to the mortgage company, the $172,649.42, and I prevent the sale from taking place, I'm said to have taken advantage of my equitable right of redemption. Why? Because I did it before the sale. Look at the illustration. But then here, right here, the sale takes place. Okay? This is the date of the sale. An investor shows up at the courthouse, buys my home that I lost to foreclosure. The statutory period of time is different in every state. In Alabama's, it's 6 months. In some states, it's 48 hours. If after this person buys my property, I can go get it back from them during the redemption period. Now, the investor who bought the foreclosed property at the foreclosure sale, if the person who lost the property comes back to redeem it from me, I am not going to lose any money. They've got to pay me what I paid for the property plus an interest rate on top of that. They've got to reimburse me for repair money plus an interest rate on top of that. So while I may lose the property to the person who it belonged to, I might be a little disappointed, but I didn't lose any money. The government made sure that I got my purchase money, my repair money, and an interest rate on top of it all. So if I get it during the redemption period, the law says I took advantage of my statutory right of redemption. Look at the illustration. Why? Because it was after the sale. So guys, when I was you and I was studying this crap, I thought equitable before, statutory after. Equitable before, statutory after. Equitable before, statutory after. I just repeated it over and over to where I memorized it. Equitable before the sale, statutory after the sale. Equitable before the sale, statutory after the sale. Now, I've had a student tell me what I'm about to tell you is on the exam. I can't believe it. I just told you that, let's say I lose my home to foreclosure, and a man buys it at the auction. And here, within the 6 months, I get the money up from somewhere, and I go to the man. I got to reimburse him the purchase price. I've already told you all that. I got to reimburse him repair money, and I've already told you all that. And I got to pay him an interest rate on top of both. I've already told you all that. But what I didn't tell you is I do not have to reimburse the person if they made any capital improvements. Now, the IRS, y'all, distinguishes a repair from a capital improvement. Like if I own rental property, a repair that I made in a calendar year is deductible, not a capital improvement. What's a capital improvement, Mark? Well, a repair is self-explanatory. But new carpet, that's a capital improvement. If I fix a hole in the roof, that's a repair. If I put a new roof on, that's a capital improvement. Okay? If I repair the furnace that ain't working properly, that's deductible in the year. If I put a new furnace in, that's a capital improvement. So any investor that buys foreclosed property, if they make any capital improvements, they know they're taking a risk. Y'all follow me? Because I'm not going to get reimbursed for any capital improvement monies I spent if the person redeems the property. I've had someone tell me that was on the exam. So just remember that the IRS distinguishes a repair from a capital improvement. And guys, again, I know enough about all this stuff to get me in trouble and maybe to help y'all get a question right. But like I said, there's a very important person in my life called an accountant. So, redemption, that's what we talked about. Now, at the bottom of the page, deficiency judgment. What if I borrowed $100,000 from a mortgage company and I've been in the mortgage for 13 years and now I only owe $77,000. That's my balance. But times get tough. Life throws me a curveball. I lose my house. Well, all the lender has to sell the property for to get their money is 77, right? They'd break even on me if they could sell it at a foreclosure sale for 77. What if they only sell it for 68? They were owed 77, so they sold the property for 68. That means they lost 9,000, didn't they? Well, even though they just foreclosed on me, now they can turn around and sue me for the deficiency and get a deficiency judgment at the bottom of the page of $9,000. So it'd be like in a boxing match. The right cross put me to my knees for a few minutes, but then in the next round, the uppercut puts me on the mat. The foreclosure was the right cross, and then they come at me with the uppercut in the next round, and that's the deficiency lawsuit. Top of page 225. A short sale. A lot of these took place during the recession. Uh, People were underwater. Most people know what that means. It's slang, upside down, underwater. You owe more than what the article is worth. Could be your car, could be your real estate, could be whatever. You owe more than what it's worth. I buy a $200,000 home. I put 10% down, so I only borrow 190. And then right after I buy the house, the recession comes about like it did in 2008. And within 2 years, my property, the value's gone down to 160. But yet I still owe 180 on it after making a couple of years worth of mortgage payments. I'm underwater. I owe more than it's worth. Well, so we're watching HGTV, and my wife says, honey, let's start looking at some houses and move. I'm tired of this house. I say, honey, we're underwater. We can't sell. I don't have 20,000. Let's say this is our situation. I say, honey, I don't have $20,000. We can't sell this house if I don't have the difference between what we owe and what it's worth. She says, oh, okay. Well, then about 6 months later, coincidentally, I get a letter, certified letter from my boss. They're relocating me to Kansas City, Missouri. I don't have a choice now. I'm not wanting to move for the fun of it like my wife was. I'm having to move to keep my job. So I call the lender. I call my mortgage company. I say, you see my situation. You know I'm $20,000 underwater. I am not moving for the fun of it. I'm moving because my job transferred me and they're requiring it. So it's their discretion. They could say, yeah, we'll let you, or no, we won't. I'd have to prove that the reason I'm moving is a dire situation. I can't just be moving for the fun of it. B, I have to prove I don't have the difference. I got to show them my bank accounts. I got to prove to them I ain't got a pot to pee in. And then if I meet these two, they're still deciding because they don't have to. It's their discretion. But basically, at that point, they're thinking, if we don't let you do a short sale, you're going to foreclose. And on a foreclosure, we're going to lose this much money. Whereas on a short sale, we're only going to lose this much money. Basically, they'd be choosing the best of the worst. You see what I'm saying? They'd be crunching the numbers. So, I want you to know what a short sale is. We've figured it out. It's where you're underwater. You can only do a short sale without having to pay the difference is if the reason you're moving is a dire situation and you prove that you ain't got the difference. And it's still their discretion. At the bottom of page 225, here's a little bulleted list of things that are covered under the Dodd-Frank Act. You don't need to know it. We're going to talk about it in another chapter, so it's not a bulleted list that you need to memorize. You can go over it if you want to. It's interesting, but over here on page 226, homeowners insurance. What are we talking about? Real estate financing. Just like car financing, if you're getting financing, you're going to have insurance. So just like you got to have automobile, you got to have homeowners. And just like in all insurance, there's a basic policy. and you can always juice your basic policy up, right? Get additional coverage. Same thing with homeowners. There is what they call this. You see coverage and claims. That first sentence says, this is a basic form policy, and you see the bulleted list of what is covered under a basic form. But then you see a broad form policy has additional protections. Top of page 227. I want you to know the very top, second sentence. Well, let me read the whole paragraph. Most homeowners insurance policies contain a co-insurance clause. This provision usually requires, we're at the top of page 227. This provision usually requires that the owner maintain insurance equal to a specified percentage. You see parenthetically, usually 80% of the replacement cost. So here's the deal. What if the replacement cost of my building is $1.5 million? 80% of $1.5 million is $1.2 million. They would only make me pay a premium on $1.2 million. I don't have to have 100% replacement cost. I could have a cheaper premium and only have 80% replacement. Am I taking a risk by only having 80% replacement? Of course I am. But this could be one of your math questions, and that's why I'm telling you. I'm not just telling you for the hell of it. So at the very top of that page, I want you to know that you're usually required to have 80% of the replacement cost with homeowners insurance. Now, guys, all y'all listen to me know we pay for the sins of others. We pay more for clothing because of shoplifting. We pay more for insurance than we should because of insurance fraud. A lot of people use insurance to doll their house up over time. Let's say you live in a cul-de-sac and a tornado comes through, tears every house up but yours. You'd think you'd be happy, but you ain't. You know why? Because your deck's 14 years old and you need a new deck. And you was hoping to God the tornado would take out your damn deck so you could get a new deck. So what do you do at 2 o'clock in the morning? You beat the hell out of your deck and you file a claim. And you know what? If you file a certain amount of claims, the insurance kicks you out of bed. So you go to another insurance company. You file a few claims, they kick you out of bed. You go to another insurance company. You file a few. People used to just work insurance companies. Next thing you know, they got a badass house. Pardon my French. That was terribly uncalled for. But you get my gist? So finally, insurance companies got tired of this. They said, we're tired of people. Your insurance claim history used to be like your medical records, private. Like doctors can't share that stuff. Finally, insurance companies said, the hell with that. They invented in the middle of page 227 the CLUE database, the Comprehensive Loss Underwriting and Exchange. This is a master database of all insurance claims. So if I file a few claims with State Farm and they kick me out of bed and I go over here to Farmers or Allstate or Alpha and they go into CLUE and they say, oh, Mr. Yarbrough, kind of like sharing medical report. We see all this syphilis in your past. I got people in my class, woo, woo. They remembering, that's what it is. Woo, syphilis burn. Anyway, I'm diverted. I'm sorry. Let me get back on track here. We talked about the flood insurance program. Y'all, I lived in a neighborhood one time, and it was in a floodplain. It was I was 25 years old. I was renting a townhome, and every time it rained like hell, they had parties because they were hoping it flooded. Need me a new hardwood floor, baby. Need me a new floor. I mean, literally, they would have parties out in the streets doing rain dances. Keep raining. I think of that every time I think of the flood insurance. I never. Your insurance person will know if you're in a floodplain. When you call your homeowner's insurance, anticipating the closing, having to have your homeowners lined up. You give your homeowners insurance their address, they'll run it through the data, and they'll know they got the maps. They know if it's in a floodplain or not. And if it is, you're going to have flood insurance. I had another property later on that was in a floodplain. I think I paid $16 a month flood insurance. It wasn't expensive, but it was a part of my mortgage payment. I had, I think I told y'all this the very first part of class, sinkhole insurance. You know, Shelby County has more, is the second highest number of sinkholes in the United States, county wise. And you know why? Because of all the limestone. You know, hadn't y'all driven through Alabaster and see all the, there's a lot of limestone in the South, period, not just Shelby County. And what does limestone do? It eats away. That's where all our caves, if anybody gone to the caves in Chattanooga and all that, that's limestone getting eat away over time. So what happens when you got a big cavity in the earth? I mean, it's a sinkhole. Stuff falls in. So yeah, if you're in Shelby County, Alabama, I highly recommend that you call your homeowner's insurance and check and see if sinkhole was a part. Sinkhole is a part of my broad form, but back then it wasn't. I had to have a separate rider, and I think I paid $8 a month for sinkhole insurance. But anyway, guys, we are at the end, and what a coincidence! It's 8:45, guys. We're spending 15 minutes doing our key point review and our quiz. Even though we're at the end of the class and you're thinking, man, we're about to go home, this is the most critical part of the evening. So pull your antennas out and let's pay attention right here. And at 9 o'clock, I'll come check on y'all. The classroom indicator needs to be doing the quiz and studying instead of carrying on a conversation. I just said that a second ago, but my microphone was muted. Hey, it was a big night, a lot of finance. If you've got some questions about finance, they might be answered tomorrow night because tomorrow night is the sequel to tonight. It takes 2 nights to cover the subject of financing. Um, but you know, my head's tired, so let's go home. Moderators, let your students sign the roster. Y'all have a safe trip home. I'll see you tomorrow night. And tomorrow night, we're doing chapters 13. Only 13. You can see that on your syllabus. I've got 18 seats left for the cram course. So if you want to sign up for the cram course, I'm just letting you know I've got 18 seats still available for the December cram. I'll see you guys tomorrow night at 6 p.m.